Yesterday was a pretty red day right across the S&P, and when we look at the year-to-date performances, in particular, UNH does stick out as it's down around 4%, and today unfortunately isn't a great day for shareholders as the company is crashing down around 13%, but with that could also bring a lot of opportunities. So two things we're going to dissect today. Firstly, this company which is down, crashing in fact in the pre-market. Why is that the case? And secondly, is this a golden opportunity to add on the dip? Now over the last year it is down around 4%, but over the last 10 years it has massively outperformed the S&P, up around 350%, and when the markets do open, this company will be trading at its 52-week low, and Wall Street considers this company to be a strong buy. Seeking Alpha themselves also give it the buy rating, and the yield will now hit around the 2% mark. So first let's start off understanding what the issue is that has driven this company tumbling in the pre-market, and we can in fact see there is a report that the Department of Justice is investigating their Medicare billing practice, which isn't a good sign at all. So let's just take a look at the actual article that does talk about that, and we can see civil probe of diagnoses that triggered extra payments to the company's Medicare Advantage plans, which doesn't sound too great, especially if they are found guilty. So as we said, this is a civil fraud investigation. Understand whether or not the company's practice for recording diagnosis actually triggered extra payments to a group that UNH does own. Now this isn't something new for 2025. In fact, we have here a number of articles that did show Medicare paying UnitedHealth billions of dollars for some very questionable diagnoses, and as we said, this is not a good look for the company at all. So in the system, we can see insurers get a lump sum payment in effect from the federal government to oversee the enrollees to their Medicare benefits, and when patients have certain diagnoses, the payments go up, creating an incentive to diagnose more diseases, which is incredibly unethical. Now it does say here the civil investigation, some of the people said, is separate from the long-running Justice Department antitrust probe, something we have talked about not too long ago, and the DOJ actually sued to block UNH's $3.3 billion acquisition of health company Amadeus on antitrust grounds. So not a good look at all. This could in fact tumble even more over the next few days, but we want to understand, is this a possible opportunity to buy the dip, or in fact maybe look to sell? So we always like to start off on how their latest earnings were, and as we can see, the headline gives it away that their quarterly revenue was a miss on weakness in the insurance unit, and when we take a look at the specific numbers, we can see their top line revenue came in at $100.81 billion, below expectations of $101.76. However, they did beat on the EPS $6.81, above market expectations of $6.72, and they also reaffirmed their 2025 target, sitting somewhere around the $30 mark. And something to highlight, 2024 was a very strange year for them. They did have a cyber attack on their tech division, and also a lot of increases to their medical costs, which did hurt their company overall. Now if we look at their historical earnings, we do like the fact they have outperformed over the last 4 quarters, giving them a 100% track record, and over the next 4 they anticipate each one, basically all of 2025, to be positive growth to the earnings per share. And with the December 2025 earnings per share estimate of around $30, this means the company is trading at a forward valuation of around 17, but given the drop, we will see this number go even lower, sitting somewhere in the 15 region. Now even though we do notice an F on the valuation, we can see the sector as a whole does sit high around 19.1, meaning you are getting a discount to the overall sector, but on top of that, in comparison to their 5-year average, the valuation for UNH is significantly lower, around 20% to be exact, and that is something that is consistent over the vast majority of valuation metrics, which does lead us to believe it could be possibly undervalued and for us to dig a little bit deeper. In terms of the growth, they get a C+, year-on-year revenue 8%, over the next 12 months anticipated around the 10% mark, which does look to be a little bit better than the sector comparative on both fronts, and not too far off their own 5-year averages. One thing we always like to draw your attention to is the earnings per share estimated to increase over the next 3 to 5 years. UNH around 15%, above both comparatives of the sector at 10.6 and their own 5-year of 13.5, so that is a good sign in terms of the growth element. In terms of profitability, they get an A+. Now gross margin 22%, significantly lower than the sector at 58, and also marginally lower than their 5-year of 24.6. Bottom line, 3.6, a lot better than the sector that's reporting a loss of -5%, but marginally lower than their own 5-year of 5.7. One thing though that does look very strong is the cash this company does generate from operations, 24.2 billion, significantly better than the sector burning through cash, -14, and only slightly higher than their averages of around 24.1. We also want to compare this company against others in the sector. We have Elevance Health, Humana, Centene, many well-known companies, and whilst all of these have been dropping in the pre-market, when we do take a look at historical performance, total return, including dividends reinvested, UNH, whilst they have pretty much nearly all of them been negative, it has been the second best performer. When we expand this to over the last 5 years, we can see it again in the top 2, up 79%, and over the last 10 years, up 414%. Whilst it is the second best, it has still significantly outperformed the S&P 500. But do bear in mind that past performance is not an indicator of the future. Now, what are the institutions doing? They do hold 88% ownership, around 40 billion worth of sales over the last year, with a little bit more buying in the same time frame. So all of 2024, we pretty much notice a little bit more buying. In the most recent quarter, we get the same conclusion. So we can see that institutions are slightly more bullish than bearish on UnitedHealth. In terms of insider ownership, well, 0.33%, we actually get some insider buying over the last year, around 500,000, but during the same time frame, we do notice sales of 3.54, and actually, for a long time, we haven't seen this, but the most recent quarter, we get a substantial buy of 512,000. In Q4, no selling, so really you'd have to go back to Q3 of 2024 to notice any sales by insiders, and as always, for transparency, we do show you, and we can see the director on the 17th of January, not too long ago, buying 1,000 shares, costing them $512,000, and this is typically what we call a bullish signal. As insiders buy, they believe the share price will increase. Again though, always do your own due diligence, never copy insiders or institutions. Now we want to run through some underlying metrics because ultimately we believe it is a high quality company. 99, very safe on the dividend score. We'll run through these two valuation metrics, but nice to see as they have historically done a double-digit increase, 12% to the dividend in June last year. Now it was just reaffirmed a few weeks ago, their very safe score, which means a dividend cut for UnitedHealth is highly unlikely. Now, how did they perform in the last recession, the 07-09 crash? They maintained the dividend, didn't increase, didn't cut, plus 5% recession sales, well above the average of the S&P that sat at -12, but they did trail the S&P, -63%, the S&P in the same time frame, -55. As we mentioned, very consistent with this company, double-digit increases to the dividend, in fact 37% year-on-year over the last 20, and they have been increasing those dividends for the last 15, whilst paying a dividend for the last 32 without a reduction. Now we're looking at the first valuation model here, but do bear in mind we're not looking at any of these in isolation, and the blue tunnel is the expected fair price. Right now it sits even lower than the bottom end, and when the market does open, the disparity will be even larger, so we will get a massive, severe undervaluation signal, and this is something that is reinforced when we look at dividend yield theory. Tells us a company is undervalued when the current yield sits above the 5-year. As we said, upon market open, it will sit around the 2%, so severe undervaluation, and the forward P will go even lower. Again, we're getting a lot of severe undervaluation right across the board, and we do notice it isn't too far off the healthcare sector. Then when we look at the free cash flow payout, as always, free cash flow over earnings, which is susceptible to manipulation by management through accounting, below 60%. This does give us faith they can offer double-digit increases we love to see, and consistently very low, 37 on a trailing 12-month, 24 over the next 12. So we do anticipate another double-digit increase June this year. And free cash flow per share, we want consistent growth over the longer term, pretty much something we get for the majority of years, and expect it to increase sharply over the next 12 months. And then we get to the sales growth, looking very strong and healthy as well, around the 3 to 7% every single year at the bare minimum. In fact, some years double digit. And from a numerical perspective, we can in fact see they have increased their top line more than double, 157 billion to 400. What they've also done, although to a very lesser extent, is return excess cash to shareholder pockets through those share buybacks. But as always, it is a nice added bonus, especially for companies like UNH who do offer double-digit dividend increases. ROIC, one of our most watched metrics. We want 10% or more. Give us faith management are able to effectively allocate their capital. double digit every single year, looking very consistent and very healthy. And whilst the operating margin is below the minimum we want to see, this is very consistent and in line with the sector and their own averages as we just ran through, so no red flag indicators, and the free cash flow straddling around the minimum we want to see at the 5% point. We then move on to the net debt to EBITDA. Below 3 is what we want to see. Numbers below reflect the number of years it would take the company to pay off all of their debt net of cash on hand. And remember, this correlates to dividend safety, balance sheet strength. 1.26 looking very good on a trailing 12 month, expected to go lower over the next 12. And as we will show you, the balance sheet does look to be strong. Now, we did already cover their top line revenue, which, as we said, has been growing at a very attractive and consistent rate over the longer term. But the main point of this part of the analysis is to understand, what does the bottom line net income do? Does it follow a similar pattern? And the answer is yes, although we can see the most recent year we do get a dip. Over the longer term, though, it has pretty much tripled from 5.8 billion to 14.4 in December 2024. We then also want to highlight the balance sheet, a quick health check, total cash versus total debt, and the cash has been increasing over the period, going from 10 billion 10 years ago to now sitting at 25. But remember, one number here in isolation will not give us any information, which is why we compare it to their total debt numerically and directionally. Similar to their cash, that has also been increasing, in fact more than doubling from 32 billion to now sitting at 77. And whilst we did see net debt to EBITDA does look to be healthy, but as always we do like to keep an eye on this just to ensure the health of the balance sheet. Finally then, the cash from operations. How much does this company in fact generate? And it is quite a significant amount, which has only been increasing, in fact nearly tripling from 9.7 billion to now sitting at 24. Now, before we do jump into our own analysis, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll be able to gain access to 45 undervalued stocks for the month of February, as well as the upside that Wall Street sees for each one of these stocks. And on top of that, you can grab a spreadsheet of 32 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then jump into our intrinsic value coming to $561. It is purely the average of these three models. So we'll show you the first one, the multiples valuation, companies in a similar sector and size, average P multiplied by the EPS of UNH to give us our first intrinsic value, which does give us an overvaluation signal. But remember, we're not looking at any one of these in isolation. Then we have the dividend discount model. We already discussed dividend increases looking very strong, very consistent. Moving forwards, a lot more conservative at 6.75, and we get our first undervaluation signal. Then we move to the DCF model, where we have the free cash flow year on year. Average growth 14% over the last 10. We've been a lot more conservative at 6. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and a second undervaluation signal. And that is where we get the 561 today. And remember, you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for UnitedHealth or any others. Now, we're not done just there, as we do always apply a margin of safety, and we start off with 10%. Execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in today's episode, a buy at around $505, then we keep going till it's near the current trading price. And we can see right now you are getting at least 20% around the $450 mark. Wall Street themselves are very bullish. They see this at 644 over the next year. That translates to 45% upside. As always though, give us your thoughts in the comments below. Maybe this is one you're looking to buy, maybe you're looking to hold, or in fact this is one you want to get completely rid of in your own portfolio. Let us know your thoughts and your strategy in the comments below. Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, and come and join us in the Patreon, where we do cover our weekly buys and sells, as we have been making movements given the volatility. And as always, have a great day. We'll see you all on the next one.